Hello everyone, I'm Christopher Tan and welcome to Providend's Money Wisdom, an original podcast inspired by my book Money Wisdom, Simple Truths for Financial Wellness. In this podcast, I'll be sharing simple financial truths to guide you in navigating through the minefields of misinformation and false promises in order to achieve financial security and peace of mind. How to invest for your retirement. In the previous episode, we spoke about how we use RetireWell, our proprietary tool, to help David set up a spending plan to give him a reliable stream of income in his retirement. But RetireWell involves investing prudently throughout David's retiring years. To achieve the returns that David hopes for, we can use a range of investment instruments to execute his retirement plan, beginning with bucket 2 to 6 in RetireWell. In executing the asset allocation for our clients, my firm prefers to use instruments that are low cost and those that do not try to beat the markets. Such instruments include exchange traded funds, or ETFs in short, as well as the BlackRock index funds. Years of research and advisory experience tell me that most investment managers are unable to beat the markets, and for those who do, it is very difficult to find one that does it consistently. The one so-called active manager whom we use and who has managed to outperform the markets consistently over the past decades is Dimensional Fund Advisors, or DFA in short. I believe the reason behind DFA's exceptional feat is attributed to their low-cost investment regime, average fee of between 0.3 to 0.4% per annum, and more importantly, their principle of not forecasting or outguessing the markets. Instead, they diversify their portfolios over thousands of stocks, like an index, and tilt their portfolio towards value stocks, small caps, and companies of higher profitability. While these methods of investing do not give spectacular returns, they give sufficient returns to our RetireWell portfolios. We are mindful that as retirement planners, our job is not to make retirees rich, because some of them already are, but to keep retirees financially secure, and for some, rich. Foremost in their minds is wealth preservation and peace of mind in their retirement. So, why index funds? The simple reason is it works. Tons of literature have shown that most active managers cannot beat the market, and we have plenty of data to show that. Well, granted that some of this data shows that there are still exceptional managers who can so-called beat the markets. However, the real problem is that they will not be able to do so consistently. If you see some of the data that is being compiled by the S&P Dow Jones, well, it shows the persistency, or rather the persistence of US equity funds performance, or the lack of it, or the lack of the persistence in their performance over a 5-year period. The conclusions that we can draw from data is crystal clear. From one of the data set, out of the 664 funds which were in the top 25% of US equity funds in March 2012, only 11.9% remained in the top 25% in the very next year. By March of 2016, only 0.3%, which is 2 out of the initial 664 funds, were still in the top quartile. Even the most recent data shows that. This shows the inconsistency of active managers and how a strategy of simply looking for the best fund performance in any given year is likely to fail. Hence, why risk your money in retirement by trying to find managers that can consistently beat the market when it is so difficult to find them? Besides, your primary reason for retirement planning is to safeguard your wealth and financial stability. One clear reason why most active managers fail is fees. Eugene Farmer, Nobel laureate in economic sciences, pointed out that before cost, active investment must be a zero-sum game in which active managers who have positive returns must have made it at the expense of other active investors. After cost, however, in terms of net returns to investors, active investments must be a negative-sum game. This is an instructive statement on investment. Now you know why my firm advocates index funds. It is simply because it is low cost. At one point in time, we were using Vanguard. Why Vanguard? Besides the fact that it is one of the top 3 biggest fund managers in the world and has the strength in terms of its size, its values in investing are aligned with those that my firm embraces. The late John Bogle, the founder of Vanguard, simplifies these values into one word: enough. In his book of the same name, Enough, True Measures of Money, Business and Life, Bogle talks about what enough means in money, business and life. In the world of finance, he argues that it is marked by too much cost and not enough value, too much speculation and not enough investment, too much complexity and not enough simplicity. In the business world, it is focused too much on accounting and salesmanship, and not enough on trust and stewardship. Our society at large is too obsessed with charisma and wealth, and not enough with character and wisdom. The mindset of having enough is aligned with the approach my team of client advisors has used to help retirees retire well. It is about not taking unnecessary risk and not incurring high cost so that we get enough returns to give a reliable income stream during their retirement. Unfortunately, Vanguard has since stopped operating in Singapore. And in order to give our clients similar exposure to index investing, we are now using BlackRock index funds as well as exchange-traded funds. Thank you for tuning in to Providend's Money Wisdom. I will be back soon with the next episode. For more information on my book or Providend's services, kindly visit providend.com. I'll see you the next time. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, podcasted, or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.